The debate over the federal debt may be a political one, but for investors, there are real consequences to hitting the debt ceiling. Here to tell us about them and how to trade accordingly is Carl Lantz of Credit Suisse. Carl is head of U.S. interest rate strategy and a former analyst at the Richmond Fed. Carl, Scarlett was just telling us there, 10-year yields are near their lowest level of the year, 3.15%. Is that a safe place to be, given what's happening with the debt ceiling?
Well, I think it is. I think it's getting a bit risky as yields get lower. Part of what's going on is quantitative easing is ending, and a lot of investors had positioned to be underweight Treasuries in expectation of that. I think what you're seeing now is those investors realizing that the end of QE doesn't mean yields have to surge, and they're coming back into the market. Now, in terms of the debt ceiling, today's the day. We've hit the limit. Our self-imposed credit card limit has been reached. What's going on in the Treasury market is nobody really thinks this threat is credible that the U.S. would default. So you can talk about doomsday scenarios, as Geithner and Bernanke have done, but the reality is no Treasury Secretary is going to let the U.S. government default on his watch. So really all that happens now is supply of Treasuries comes down one way or the other.
Okay, so it becomes a structural situation, right? If supply of Treasuries comes down,
right,
how does the bond market behave?
Okay, so the Treasury is going to do everything they can to keep coupon issuance stable. So they don't want to reduce the 2-year note or the 3-year note, the 10-year note, the 30-year note, because they don't want to have to cut those issues, have the market rally a lot, and then bring them back. It's what they call churning. So what they do is reduce the issuance of Treasury bills. These are your 4-week, 3-month, 6-month bills.
The short-term stuff, yes.
And we're already back to the lowest level of bills outstanding as a share of the Treasury market in 50 years.
Because the government has been trying to extend its maturities.
It's been extending its maturities. And now we're in a situation where basically every week that we're under this debt ceiling, we have to cut issuance of Treasury bills, or the outstanding amount of Treasury bills, by about $15 billion. So that pool of money gets smaller and smaller. And on the other side, you have your money market funds, your mutual funds with their cash balances, all trying to invest in the shrinking pool of securities.
So, Carl, T-bill rates are already fairly low, but
yes,
it sounds to me like you're making the case for a no-brainer trade.
Yes.
Go short, go 3 months, 6 months, and you will actually make money. Why? Because the interest rate is going to go below zero?
Right. So 2 weeks ago, we recommended buying 6-month bills at 8 basis points, and some investors scoffed. They said, as a rate strategist,
you're not being paid a whole lot of money to hold those bills.
Is this your best idea? Now, for your average investor, it's not a whole lot. But now for the hedge fund community that can borrow them with leverage and finance them in the repo market at 0%, they can actually leverage those returns quite a bit. And yes, I think all those rates are going to be going to zero out to, say, 6 months, 6 to 12 months into the low teens. And this is just going to make what's already a difficult situation for money market funds even worse.
So just one quick question before we end up. This is a very temporary situation. This trade is good until when? Until they come to an agreement?
Eric, I wish I could say it was temporary. It's until they reach an agreement, and the administration has said we can make it to August 2nd, and the hope is that Congress will want to get out to their August recess with a deal. But because of the Treasury market's reaction, what we're hearing from D.C. is a lot of the freshman Republicans are saying, look, the market's not worried about this. And, of course, it's because the market doesn't believe anybody will default. So this could stretch into the fall, and it could get dicier and dicier.
Well, you know better than me. The market isn't worried about this until it is.
Until it is. Until they put something on the floor and vote it down like TARP.
All right.
That's
Carl,
the worst case scenario.
Thank you for coming in. Carl Lantz, head of interest rate strategy at Credit Suisse, talking to us about the debt ceiling and, most importantly, what it means for the bond market this morning.